Okay, hello everyone. I think we'll probably get started now. So I want to start off by welcoming you all to Tuesdays with TD. And today we're going to be talking about home ownership here in Canada. So I want to start off by the traditional territories acknowledgement, and we're going to play a recording today for this.
The University of Manitoba campuses are located on original lands of Anishinaabe, Innuit, Unsinannuak, Dakota Oyate, and Dene, and on the national homeland of the Red River Métis. We respect the treaties that were made on these territories. We acknowledge the harms and mistakes of the past, and we dedicate ourselves to move forward in partnership with Indigenous communities in a spirit of reconciliation and collaboration.
Thank you all. So a little bit about myself. My name is Tyler. I graduated with a BCom back in the spring of 2024. I was from the University of Manitoba, IH Asper School of Business, and my majors are finance and human resource management. And now I work with TD in their agricultural business, which is a branch of commercial banking. For the home ownership in Canada topic, we're going to have Danica Rico and Steve Very talking to us. Danica and Steve will walk us through what you need to know if you are considering home ownership here in Canada. I'm now going to hand it over to Danica to speak about the first-time home buyers.
Thanks, Tyler. So I'm going to quickly send it over to Steve, but I will say before I do, thanks for hosting us here today. You're going to get a couple of perspectives. You're going to have my perspective as a financial planner, just as some considerations when you're thinking about purchasing a home and just setting aside the home itself, but looking at your own personal finances and making sure that you're set up for success. Steve is a mortgage specialist with TD, and he's going to help us by understanding and going through the homeowner process and talking about the different types of mortgages that we offer. If there are things that you are interested in that we have not brought forward in the presentation, please send a quick chat message or Q&A question for us so that we can make sure that your questions are answered and it's relevant to you as well. We want to make sure that this is as knowledgeable and informative for everybody who's joining. The focus will be primarily on first-time home ownership, not to say that we can't answer any questions around individuals who are looking at upgrading, downgrading, or changing their perspectives. So with that, I'm going to pass over to Steve to talk about home purchasing and making an offer, and I will jump in as we go. Go ahead, Steve.
Thank you, Danica. So first, if I could start with indicating this presentation is intended for information purposes only. The information provided is not intended as financial, tax, legal, accounting, or other professional advice to you, and should be relied upon in that regard. As always, please consult with your appropriate professional advisors to discuss your specific situation. I guess for today we'll be discussing, four topics. Basically, before you make it the offer of a home, buying the home, your home buying team, and closing the deal. These topics will walk you through valuable insights and tools and empower you in your home ownership journey. The important decision is not one to be taken lightly and requires thoughtful research, reflection, and education to understand the variety and variables that make up this purchase. We will spend approximately about, I would say, 5 to 10 minutes, maybe 15 at most, on each topic. So, am I ready to buy? To help support your decision, consider starting with maybe a pros and cons list of home ownership, possibly versus renting, because it isn't maybe right for everyone at the same time. There are opportunities and strengths to both decisions depending on your specific personal goals, priorities, and your timeline. Ask yourself what's important to me. What's your overall goal, and how does the decision, fit into your priorities?
Steve, can I add something here too?
Sure, please do.
Something that in our society tends to be really prevalent is how important home ownership is. And one of the really big things that we don't factor in is lifestyle. And so I manage a book of clients that has about 275 different households. And a lot of those people own their own homes, but there are many who choose not to own a home based on their lifestyle. And so, just like Steve mentioned, when you're thinking about, is this the right time? One of the biggest factors that people don't consider is the impact to your overall lifestyle. I want to give an example of a client that I had recently. And so she came into my office and she had been pushed really hard into purchasing a home. However, upon further conversation, we talked about her lifestyle and talked about how she loved to travel and she loved to have free cash flow. Her rent was about $1,000 a month and it was shared with somebody else. And she was comfortable with that number. And so through our conversation, we recognized that purchasing a home was going to increase her housing costs quite substantially to a point where she wouldn't be able to do the things that she wanted to do anymore, traveling, going out with her friends, enjoying those components. And so when you're factoring in and thinking about, is home ownership right? Am I ready to do this? A big component of that is making sure that you understand the impact on your lifestyle and how it impacts what you do on a day-to-day basis to make sure that this is the right decision.
Depending or deciding, I should say, to take on home ownership, comes with, like I said, a considerable financial commitment. It's a long-term commitment. Questions maybe you should be asking, like, will the property be a starter home? Some people start getting into the housing market because they know they just want to own a home, have a piece of investment in something that's theirs, and maybe just be there for 3 to 5 years possibly. Or is it going to be a forever home? We're seeing that a little bit more where people are buying, up to their maximums, maybe even building for their first homes so that they don't have to move in a very long time and they can grow roots and don't really have to move with their professions. So that is an option to consider as well. Connect with family and friends and ask questions about their first time home buying experience as well. Leverage that. Absolutely. Another question, where do you want to live? So, we live in the city of Winnipeg. So do you want to live in the city? Do you possibly want to live outside of the city? So there are pros and cons to both. Something to consider, and maybe having a sit down with a realtor professional will help you also make that decision too. What kind of property slash dwelling? So what I mean by that, do you want to have a resale, like existing home? Is that the first home you want to buy? That might be a $300,000 1960 home in Winnipeg. Or do you want to buy a condo, something that you don't have to do a whole lot of upkeep to, and have a little bit more of a turnkey lifestyle sort of, but with, the pros and cons that come with the condo as well. Possibly, purchasing a duplex. So I'm seeing people now, first time home buyers are buying duplexes where they can rent out one side and live in the other. That's also a very unique aspect too. Location, be mindful of the surrounding community and neighborhoods. What amenities are important to you? Do you want wide open space with lots of land? Or versus something quick with, quick access to amenities, for a young family with shopping, being close to schools, things of that nature. And one thing to consider for sure, and this is what I see a lot of in my experience, is maybe thinking about the property you're looking at and what type of cost you might incur with that specific property in the next 5 through 10 years. There are a lot of older homes now in Canada, so they require a little bit more maintenance costs. So maybe you might have to redo a roof. You might have to redo some windows, things of that nature, hot water tank, furnace, all those kinds of things could be additional costs that should be considered when you're kind of looking at homes and whatnot.
And so when you think about how much you may be able to afford, as Steve mentioned, it's not just the mortgage payment. And so a lot of the time, when we tend to compare housing purchases, a lot of people say, well, my mortgage would be $1,600 a month and my rent currently is $1,600 a month. So I'm paying somebody else's mortgage right now, and I could jump into my own property and be building equity over time. But the reality is the mortgage payment is only one factor of your overall expenses when you go into that that home. So you're going to have your mortgage payments and you're going to have your property taxes. If you opted to buy a condo instead of a standalone home, then you're going to have condo fees, home insurance, utilities. And the biggest factor when I look at clients is maintenance costs. People do not tend to factor in the cost of that home maintenance. And it, particularly, as Steve mentioned, when you have a home that was built a little bit older, 1960, 1970, a lot of our houses are early 1900s, there's going to be additional maintenance and repair. And the reality is that if you don't have any maintenance and repair in 1 year, you're probably going to have a large bill in the next year or the next year following that. And so typically what we want to see is we want to see at least $3,000 to $5,000. Some individuals will say 1% of your overall cost of home ownership. I tend to say 3 to 5 minimum per year that you're putting aside, and you're building a maintenance and reserve fund, because if something doesn't blow this year, it's going to happen in a future year. And instead of getting behind the 8 ball where you're going to have to borrow more money to cover that expense, it's better to get ahead of that 8 ball and have that money saved so that you can cut the check when it comes up. If you want to jump to the next slide for me, Tyler. One of the things that I like to bring up, and this is relevant to my own personal experience, I've been in the industry for 18 years, and I recall a conversation I had with my sister-in-law about 10 years ago, and she was going in and purchasing her first home. And so she went in and saw our mortgage specialist, and she did the calculations and found a number that she should be able to purchase. And so in that conversation, the mortgage specialist said, great, you can purchase a home for $350,000. So my sister-in-law went out and purchased a home for $350,000. And about a year later, she comes back to me and she says, Danica, I don't understand. The bank said I could afford this home, but I can't. It's very expensive. I'm going into debt every month. And so I don't understand why I'm able to purchase a home for this price point when I can't truly afford it. And I went back to my sister-in-law and I said, well, the reality is that the bank is going to look at your gross income compared to your gross expenses when we think about your debt, when we think about utilities, when we think about property taxes, and we think about that mortgage. And we're going to divide those two numbers together, and we're going to get something called a gross domestic, is it a service, Steve? GDS? Gross domestic?
Yeah, gross debt service and TDS.
Perfect. So gross debt servicing. And that is going to be for everybody. We don't compare lifestyles. And so the reality is, for my sister-in-law, we don't acknowledge the fact that she has daycare expenses for 2 children. We didn't acknowledge the fact that she likes to go out and eat 5 days a week and doesn't want to cook at home. And so those things, as we mentioned earlier on, when it comes to lifestyle, are critically important when you factor in your budget for home ownership. When I sit down with clients, typically what I'm going to do is I'm going to work backwards, and I'm going to say, tell me, what can you afford to put out towards home housing expenses on a monthly basis? And everybody's going to have a different number. And they might say, you know what, Danica, I can afford $2,150 a month to go towards a house, and that's still going to be able to maintain the lifestyle that I have. And instead of going in and saying, great, we can afford a mortgage of X amount of dollars based on our GDS, we go in and we work backwards. So if you can afford $2,150 based on your lifestyle, how much of that needs to go to emergency fund? How much to utilities? How much to home insurance? What needs to go to condo fees and property taxes? And then after all of those, what do we actually have for your budget that can be leveraged for a mortgage payment? And based on that mortgage payment, what can we purchase as a home ownership? By doing it that way, you can ensure that you're not sacrificing your lifestyle, that you still have the capacity to save for other things that are important to you, to save for retirement. Maybe there's vacations you want to go on every year. Maybe there's daycare expenses that you need to cover. But making sure you have a clean understanding of your budget before you go in and purchase the home is going to set you up for success and reduce the stress load year over year. Another thing that I will tend to tell clients is that, role play it for 6 months. So if we say you can purchase a home for $300,000, and these numbers I have not accurately come up with the breakdown mathematically, but if that home is going to cost you $2,150 and you're currently spending $1,500 in housing expenses between your utilities and your rent, my advice for you is to take $650 a month and set it towards a savings for 6 months. If you can do that comfortably, then you know that the housing cost of $2,150 is going to be manageable for you once you purchase the home. If you can't, then you know that this is a bit too expensive and maybe you want to scale down on that home ownership. Again, making sure that you plan your lifestyle and expenses is really important to make sure you're set up for success long term. Do you want to jump to the next slide there, Tyler? If we factored in our budget and we know how much you want to buy for, the next piece is your down payment. And so for your down payment, you at minimum have to put 5% down for properties that are under $500,000. And Steve, I might get you to talk about the different down payment factors, 5%, 10%, 20%, and those impacts when we talk about CMHC.
For sure there. And just before Steve jumps in, we do have a quick question here. There was a question, is 1/3 of gross income for housing still a fair guideline?
Steve?
I actually don't even know if I look at it that way, to be honest. So was that question in terms of affordability, 1/3?
I believe so. If the person wants to add something here, they're welcome to, if they want to elaborate on that a little bit further.
So I'll walk through sort of what I do with every application when a client comes to apply to see what they can afford when it comes to a home. Essentially, I just do the pre-approval, and we just kind of talked a second ago about total debt service and gross debt service. Typically, you can't really exceed 40% of your gross monthly income towards your entire overall debt picture. So all your minimum payments, your credit cards, your loans, your mortgage payment you're applying for, property taxes and housing costs can't exceed about 40%. If that maybe answers the question or not.
Yes, there was nothing else added, but I do believe it comes down to affordability and monthly payments, the 1/3 of your gross income.
So I would say to that, 1/3, when we look at your overall picture for debt, as well as mortgages, it's 40%. If you broke that down and said that you had no debt at all, what could you afford towards housing costs? Steve, would that still be 40%?
I think so. Again, I don't really look at it in terms of that aspect. We don't even really talk about a 1/3 sort of rule. So I'm not sure. It sounds pretty close, but again, when it comes down to affordability, it really comes down to just 40% of everything you make, and 40% of your gross monthly income cannot be exceeded sort of towards all your debts. So whenever I cap the application for affordability, as long as we're at 40% of the gross monthly income, including all your debts and the mortgage payment and housing costs and everything you're applying for, that is an approvable criteria from an insured perspective and from a conventional mortgage perspective.
Steve, did you want to continue on with that down payment conversation?
Yeah. So right there, it's indicating like the minimum is 5%. So in Canada, you can actually go and apply to buy your first home with as little as 5%. I have a couple of notes here. Sorry, I'm just going to catch up here a little bit. What I would say is that when borrowers want to do that, borrowers must demonstrate that a portion of their down payment has to come from personal resources, not borrowed. So that 5%, that first 5% has to come from their own savings. Examples might be just bank savings, investments. Also, it could be also uniquely changed to a gift. So understandingly so, some people have good credit, good income. They may not have necessarily that 5% to get a mortgage approval, but you can get a gift from an immediate family member if it's going to be an insured application like that, which we do quite often. Also, too, a little bit more complicated, but when people own one home and they're moving to another home, there is equity tied up in sometimes their previous home that they've sold contractually. Well, we can actually give a temporary loan against that sale contract for a week, 2 weeks, 3 weeks, a month, depending on how long the closing dates are for people to move into another property. As you increase from 5% to 10%, the Canadian insurers, there's 3 insurers, they charge a different premium calculation. So it's basically a high ratio cost that gets added to your overall mortgage. There is an option that if you are putting down, let's say 5%, that cost maybe $4,000 or $5,000 on a $350,000 home, to pay that up front. No one does that. So what your option is, and what most people do, is it gets added to your overall mortgage. So if your mortgage was going to be in the end $325,000, it would be $330,000 over 25 years, your standard contract for a mortgage. So I think that's what I have to say about the 5, 10, and 15%. As you get to 15%, that is the premium calculation changes. And then at 20%, it's a conventional mortgage in Canada. So what that means is that you're coming in to the lender. The lender is not seeking insured backed approval, and there is no additional cost. You put down 20%, the bank will finance you the other 80%. If you put down even a higher down payment, then you're just going to mortgage that other percentage of 70% if you put down 30%. The cost associated is for high ratio mortgagers, which are people putting down less than 20%.
And to follow up with that, when we think about CMHC insurance, just for clarity, what this insurance is an insurance that says if you go bankrupt because you can't make your mortgage payments, then the bank is insured where any of the money they can't collect on the sale of the home, that CMHC coverage is going to cover that difference. And so this is a protection to ensure that banks across Canada don't go insolvent as a result of a number of people going insolvent due to home ownership inaffordability over a period of time. And so understanding what that insurance is for is important. Additional
And
to this,
also,
yeah, go ahead.
oh, sorry, I was just going to add really quickly that there's actually a system by all the lenders. So as soon as you are going in to apply for your mortgage, your deal goes live, is accepted. Automatically, the computer systems at all the lenders will automatically send it to one of the three insurers. So one of the insurers is Canada Mortgage and Housing Corporation. The second insurer that comes to my mind, Canada Guarantee. And there's a third called Sagen. So automatically it goes to one of them. There's no difference. It's just so that there's not a monopoly of one insurer in Canada. So there's three in Canada. And if you're putting down less than 20%, it's going to be actually backed by one of those insurances.
Yeah, thanks, Steve. Another question that comes up regularly is if I don't have a 20% down payment now, and it's going to take me 5 years to save that down payment, but I could put a 5% payment down today. Does it make more sense, Steve, for me to buy a home with a 5% down payment today? Does it make more sense for me to save and put down the 20% in 5 years?
That's a good question, and I don't know the quite answer to that. In
I
my
do.
opinion, though, okay, so there you go. I was pretty sure the financial planner would have that answer. You can talk about appreciation and all that, so please go ahead.
The answer is do it today. And the reason is do it today is that inflation, home ownership costs go up. So if we say in Manitoba, for example, we are not a boom and bust type of environment. Vancouver and Toronto, you tend to see housing markets come up and then they come down and they tend to boom and bust. In Manitoba, we are a steady eddy. And so, yes, we might have small price fluctuation deviations, but overall, we're going to go up with cost of living. And so that's typically inflation. If you have to diligently save for 5 years, the cost of that home is going to be 2% more per those 5 years. So if you go with, let's say, a very easy number, $100,000, you buy a home, which is unrealistic, but next year it's going to cost $102,000, and the following year it's going to be $105,000. And so you're actually losing out on that equity and that growth over time because you're using a leverage strategy. It would be more beneficial for you, provided you can afford the mortgage payments, to get in sooner and eat the CMHC fee than wait and put a 20% down payment 5 years down the road. Steve, do you have anything to add on that one?
Just a little bit on how I see a lot of, first time home buyers. And, I have people really trying to get to that next percentile, because what I mean by that is from 5% to 10%. Sorry, I had something pop up here. 5% to 10%, so they could pay that lesser premium. And they kind of are using everything they have in some cases to go from that 5 or 10% or that 10 to 15%. I'm just sort of an advocator that I kind of feel like people, and I think Danica spoke to that, as having some savings, because a lot of these buyers are buying these homes, and I'm getting phone calls of, later on down the road, and my furnace went, it's going to be $8,000 to $12,000, or the roof needs to be done, and all these things. And by paying that smaller premium and saving that maybe difference from a $5,000 premium to a $3,800 or $3,900 premium difference by putting down 10%, it's probably best to probably do the smaller down payment and have that money liquid, especially in the market today. So I just want to speak quickly on that a little bit. And I do see that a lot where people are thinking that it will be a huge savings to go to 10% versus 5 or 15% versus 10. But if it's really everything you have at that moment, it's probably best to maybe curb that back a bit, pay that slightly higher premium, and have that money for that rainy day.
Yeah, absolutely. And when you think about it too, if you put everything into the house and then something blows, now you've got to find credit in order to fund that. And that credit is going to be at a higher interest rate for a prolonged period of time. So it would be better to have that lower payment on the mortgage and have extra cash available instead of using those credit debts that are at a higher interest rate. If you can go, Tyler, to the next slide for me, that would be fantastic. So when we think about down payments, Steve spoke to this already. Your payments can come from a gift from a family member, provided that it fits in a certain criteria. But you also can save for that. And there's a couple of different vehicles that we can save for. And two of the more prominent ones that we talk about quite frequently is the RSP First Time Home Savers, which was the only option from a registered perspective other than your tax-free savings account until this year. And then this year, the first home savings account became an option as well. And so I did want to spend a little bit of time talking to you about the difference between these two vehicles because they're pretty cool and they have some benefits to them. So your RSP is typically designed to save for retirement. And when you put money into your RSP, you're going to get a tax break. So if you make $50,000 a year and you put in $5,000, the government's going to say you actually made $45,000 for that year, and you're going to get a tax refund on that $5,000 that you put into your RSP. Now, typically the idea behind the RSP is that you save it for retirement and you take it out down the road. And when you take it out, you're going to pay income tax on it, but at a lower tax bracket, so you're going to be making less money in retirement. However, the Canadian government recognizes that home ownership is challenging at the best of times, particularly with rising costs. And so what they've done is made it available where you could take money out of your RSP for the down payment on your home. Now, when you do take money out of the RSP, you're not going to pay any income tax on that. However, you have 15 years to pay that back in. And if you don't put it back in year over year, it gets added onto your income. That number used to be $35,000 that you were able to take out of your RSPs. And in 2024, they increased that up to $60,000 to make having a down payment a bit more functional for people. At the same time, they started offering the first home savings account. And so this is a new account that Canadians can access if you're a first homeowner and you're trying to save to become a first homeowner. And so what this is it allows you to put up to $8,000 per year to a maximum of $40,000 in here. And so what happens is on the front end, it acts like an RSP. You put $8,000 in. If you made $50,000 this year, the government's going to say, hey, you made $42,000 and we're going to give you a refund on that $8,000 you put into your first home savings account. And then you can invest that money in different vehicles, GICs, cash savings, mutual funds, stocks, bonds, those types of things. And as it grows, so if that 8,000 grows to, let's say, 10,000 by the time you purchase that home, you can take that money out. But unlike an RSP, you don't need to repay it back in. And unlike an RSP, there's no tax implication. So you take that full money out tax-free. So on the outside, it acts like a tax-free savings account. If you don't end up purchasing a home, you can take the full balance of your first home savings account and roll it into your RSP. So when you're looking at saving for your home, you have a couple of different options: RSPs, first home savings account, tax-free savings account, or general savings accounts. And depending on your tax brackets and what's available to you, you're going to want to look at those different vehicles to make sure you're setting up yourself for success. The other piece to think about is, of course, we're going to save for that down payment, but you're also going to save for your closing costs. And so there are going to be closing costs that are associated with your home purchase: legal fees, paying your lawyer, land transfer taxes. And I think, Steve, you mentioned something around the percentage allocation for Manitobans, because generally across Canada, it's 1.5 to 4% of your purchase price. But Steve, you have something that's a little bit more accurate to Manitoba. Is that right?
Yeah, well, we're actually mandated as a lender. Probably all the major banks are the same, but for an insured application, we are required to confirm that there's a minimum of 1.5% in additional savings on top of the down payment to close the real estate transaction. But from what I see, I don't think it's quite enough, and I believe 2% is a better calculation to use. So that could add up, and if you have a $300,000 purchase with 5% down, $15,000, and then you have to pay this cost to the land transfer tax of Manitoba, which is actually one of the higher costs in Manitoba, unfortunately. Your lawyer fee, which could be an additional $1,000 to $1,500, and all the applicable charges they charge when they do a transaction. It's probably closer to 2%. So it's not really going to be just at 5%. It's really going to be closer to 21,000 versus probably 15 in the end. So it can be pretty expensive to get into home ownership.
Yeah, and depending on who you've spoken to, I remember when I bought my first home, nobody told me about that closing costs. And so I was shocked when I got the letter of closing statement from the lawyer showing the bottom line that I had to generate a draft for. And so it was a pretty big sticker shock because I thought I was doing a 5% down payment. And then I saw this bulk of this extra land transfer tax. And so making sure that you're prepared for that is really important. Tyler, the next slide, I pretty much jumped into this already. I got ahead of myself. I'm really excited about the first home savings account. I think this is a huge win for Canadians, particularly ones who haven't purchased a home. And so I highly encourage you to look at the first home savings as a functionality for putting money aside for that home purchase. Really on this slide, it talks about everything I spoke to in the previous slide, but really making sure that we're using the right strategy for you is going to be important. Everybody is going to look at these in different ways. And so looking at your current taxable income is really important to decide which vehicle is right for you, particularly when you're using an RSP. The first home savings, I think, is a pretty big no-brainer to use that one first and get the tax rebate, and in additional, get some tax-free growth over the long term. If we want to jump, perfect. Steve, I'm going to send it back over to you for buying a home and talking about that process there.
Thanks, Danica. So what is a mortgage? I guess we'll talk about that. So with that, depending on your down payment, there are two types of mortgages: conventional mortgages. So a conventional mortgage, that term means it's basically a loan that is equal to or less than 80% of the lending value of a home. This requires a down payment of at least 20%. So high ratio mortgages, I might have touched on that terminology earlier with the 5% down, 10% down, anything under 20% is a loan that is over 80% loan to value of the lending value of a home. And this means with the down payment of less than 20%, of course, which will require mortgage loan insurance that we discussed as well with the three insurers. The longer you extend the amortization period, the lower your payments are. But the insured applications, high ratio mortgages, you can actually only go up to 25 years. Insurers are not allowing anything past 25 years, which is pretty standard for the last probably, when I first got into lending about 15 years ago, I think we used to do up to 30 and 35-year amortizations. They used to have a 40-year amortization, and due to risk levels and the economy, they kind of curbed that away. The insurers decreased their risk and changed that. Now, I do believe they're going to be, and they have already started to allow 30-year amortizations for high ratio mortgages of first-time home buyers that are building brand new homes to increase probably housing starts and whatnot. But if it's a resale transaction, I don't believe any lender has a capability yet, and I don't think it's approved to do 30-year resale purchases with 5% down or 10% down. I think that might be the next thing that we're going to see because they want to increase and have people buying more homes. But as it stands right now, 25 years on an insured high ratio mortgage with 5% down, anything less than 20% is the maximum. Lenders can do 30 years if it's a conventional mortgage. So if someone has a lot of equity in their home, you could probably get away with doing a 30-year amortization. But most of the lenders they charge a premium to that. So for example, on a 25-year mortgage today, most of the lenders might offer, let's just say, about 4.8% on a 5-year mortgage or something like that. That would be 4.9 if they lent it to you at 30-year amortization, because it's a longer risk level. It's a longer debt that they're going to hold on the book. So it's 10 basis points. So payment schedule can be different types of schedules based on how someone wants to pay their mortgage. So I get asked all the time, like, what's the best thing to do? Should I go pay, monthly, bi-weekly, semi-monthly? I kind of tell clients, do what you're most comfortable with. What I see is a lot of people that rented previously, they actually will probably stick to monthly because that's what they know. Someone who moved out of their parents' home and rented an apartment for a year or two, and then they bought a house afterwards as their first home. Sometimes they're already kind of have that life of budgeting for one larger payment. But a lot of employers pay bi-weekly. So I tell clients, frankly, it's probably best, in my opinion, that when you're paid, a payment comes out right away. So that, you kind of live within the means a little bit easier, and you can't go away and spend extra monies that you shouldn't have for your mortgage payment. But typically speaking, yeah, I think you're going to be paying your mortgage a bit quicker if you go bi-weekly versus semi-monthly, because semi-monthly has 24 pay periods a year. Bi-weekly has 26. My advice, though, I'm not too worried about, if I was paid semi-monthly, I would probably still have my mortgage come out semi-monthly and just make extra payments. So there's several flexible features that lenders offer on their mortgage. What that would be is prepayments, which will allow you to pay off your mortgage faster, which I'll talk about, I think, in a few minutes more. So I wouldn't get too bent on the payment frequency. Just do what's best for you, because your prepayment privileges will allow you to do quite a bit more. The big choice is rates. So there's two real, boxes that you can choose from. There's fixed rates and there's a variable rate. So fixed rate, essentially, that's just what it sounds like. It's your mortgage rate that is guaranteed and will not change for the duration of the term. So someone comes and they buy their first home for $350,000. Typically, most of the time, it's going to be over 25 years if it's a high ratio mortgage, because you can't get longer right now. But if you are someone who isn't a huge risk taker and you want to make sure that your payment won't change for that entire 3 or 5 year term, that's the peace of mind option. So peace of mind buyers should probably go fixed. Right now, we're seeing rates going down for the first time in the last 6 to 8 months, probably. Bank of Canada has been changing rates, and variable actually was sort of discouraged for the last 3 years because rates were on an upward trend for quite a period, and now they're going down. So variable is a little different, where you're going to take advantage of interest rates possibly going down, hopefully. So as interest rates in the economy go down, Bank of Canada lowers rates. Usually that affects your variable pricing because it's based on a prime rate of the bank. Right now that has been going down the last few times. And I'm thinking maybe Danica might have a few different words to talk about the interest rate environment, maybe, if she has anything to say.
Yeah, I mean, I definitely have looked at this a lot with clients over the last 24 months. And so, as mortgages come up for renewal, what we looked at pre pandemic is interest rates were as low as 1.74%, 2.25%. And so, those mortgages are now coming up for renewal. And there's a big conversation on, what do we do? Do we go with a fixed rate mortgage, or do we go with a variable rate mortgage? And as Steve mentioned, a lot of that comes down to what you are most comfortable with. What we do know is that interest rates are anticipated to continue to fall over the next little while. We just got news about inflation hitting 1.6% in September. And so that means that we're in pace for bringing down those interest rates. How quickly they fall, however, we don't know. And that's really contingent to month over month data, quarter over quarter data, and Bank of Canada looking at what we're seeing economically over time. When you go in right now and you look at current fixed rates versus variable rates, fixed rates are falling in that 4.5 to 4.9%, whereas variable are actually sitting around 6.05. Does that sound right, Steve? Around that 6% range, 5.9?
TD's variable right now is 6.04. Yeah.
Yeah. And so when you look at it right now, if you were to opt for a variable rate, you're going to go with a higher rate than you are with a fixed rate. And you're banking on interest rates falling enough to justify taking that 2% premium over that term of your mortgage. Now, earlier on in the year, I had done this calculation for some clients and illustrated the difference between taking a fixed rate in the current interest rate environment versus a variable. And the interest rate had to come down by over 1% in a period of 2 years in order to justify taking on the risk of variable. And the probability of that is it's possible, and it's just it could be probable. It's a matter of what is going to happen over the next 24 months when we look at that continual inflationary data. And so if you're looking at the pros and cons between fixed rate and variable, variable historically, if you look at somebody who holds a variable rate mortgage from the time they bought a mortgage till the time that they paid off their mortgage, and they never deviated and they always stuck with a variable, they never went fixed, they tend to pay less in interest than somebody who goes with fixed rates. But if you go back and forth, and human psychology tends to go back and forth because it's hard to run a variable mortgage when interest rates are coming up, then you're better off going with a fixed rate. So again, think about what you're comfortable with. Think about what your risk aversion is, or your risk capacity is, and then make that educated decision from there, leveraging your experts, working with your financial advisor, working with your mortgage specialist to make sure that you're taking on the right approach for you. Back to you, Steve.
And really quickly on the variable, I will just mention that, thanks for putting it back, Tyler. The variable is unique in the fact that you can switch it though. So there's a really good point on like when would be a good point to do that, because really you're just trying to time the market. I'm seeing some buyers taking variable now that can stomach that higher payment, and it's pretty substantial. Like, on a $700,000 mortgage, right now, I think a 3-year rate's probably around 3-year fixed rate is about 4.5, 4.6%, but someone's taking it at 6% today. Most lenders, I think, will allow you to switch it to the equivalent term if you want to switch it. So some people are thinking that might be a good timing factor for the next few years of variable. I've never been a variable client, but I've always taken fixed, and I just wanted peace of mind, and that's who I am. So, my first mortgage rate was 4.9%, and I just watched rates fall, and I just sat there like, oh, I made a mistake, but you know what? I didn't. It was really what was comfortable for me. I could afford it, and that was fine. And really, that's how I have worded it to my clients. But variable is unique, and I think most lenders can let you switch it at no cost, no penalty, as long as you're locking in usually to the equivalent terms. So if you have, let's say, 4 years left or 3 years left, you have to switch it to a 4 or 3 year or longer rate, and that can be kind of advantageous maybe in the next year or two.
There's just a question here in the Q&A. Is a shorter term fixed rate a logical idea? 2 years rather than 5 years?
That's a good question. The 2 years actually a pretty high rate, so it is a bit discouraged 1 and 2 years because of the fact that maybe the bond yields are much higher. I don't know, but yeah, I don't see a lot of my clients taking that. Like, I could just check really quickly because I haven't had someone ask for a 2-year, but I just told you 5 point on a 2-year fixed mortgage, 25 years is about 5.5%. So if someone's buying their first home and they can get in at a 3-year, I was wrong. I said 4.5, 4.6 at a 3. It's 4.84. So that's a big difference. So, if someone wants to do it, it is a good option. I like being able to renegotiate my mortgage in a 2-year period, but you're going to be paying for that through the rate a little bit. Yeah. So that's a good question.
Typically what you're seeing right now is, so in a regular interest rate environment, the longer you lock in, the more preferred the rate is going to be. Actually, we're already back to that, I think, Steve. And then the shorter that you lock in, the higher the interest rate. If you look at 3 years and 5 years right now, a 3-year term is 4.84, I think you said, Steve, and a 5-year is 4.74. And so if you don't want to lock in for a long term at 5, knowing that interest rates are falling, you're probably better off going with a 3-year right now, where, yes, okay, the interest rates are probably going to fall over the next 2 years, but you're going to pay less in interest quite substantially than going with a 2-year and taking on that lower rate. Hopefully it makes sense after a 2-year period.
I will add one thing too that is actually really unique. And this probably, I can't remember when this came out, but I've been working for TD for 23 years and doing mortgage for the better part of 15 years here. And they came out with actually, and I believe most of the lenders have this, it's actually preferred pricing for high ratio mortgages. There's a lot of cost involved. Someone's buying the home with 5%. So with having that mortgage back loan insurance, because you only had the 5% or 10%. I'll give you an example. A high ratio borrower that's putting down 5, 10, anything less than 20%. We were just talking, the 3-year rate was around 4.7, 4.8%. Well, it's 4.59 for a high ratio mortgage. So it's a bit of a preferred rate. They have closing costs. You're going to have that at CMHC fee that's added to your overall mortgage. So it's kind of nice. So it really helps out the people that are trying to get into the housing market a little bit with a little bit better of interest rate. So yeah, getting pre-approved for the mortgage. This is, in my opinion, probably the most important part. The reason why is because it gives you that foundation. It lets you know what you can do. I really do think it's the first step in the home buying journey for your first home. The application will give you, a realistic value of what you can comfortably afford. Because, like I said, when I meet with a customer, we'll actually pull your credit. We'll do a credit check, and it'll actually let me see, what balances what someone may have on their credit card, their lines of credit, and we have, certain calculations we do for all those types of debts. Essentially, it's 3% of the outstanding balance. So, someone has a $10,000 credit card and they got a $10,000 balance on it. We have to incorporate a $300 payment on that credit card, regardless of what it is. If it was going to be, maybe a small, teaser interest rate, you only have to pay $100 a month on it or something. We can't do that. It's always going to be 3%. So by doing the pre-approval, we can be pretty exact in finding out what is your potential ceiling, so you can go work with your realtor. And then basically looking at a frame at a good price point, and then getting pre-approved is really important. It's not a guarantee, I will say. So when people get pre-approved, we'll do our best. We will actually do the calculations. But what I mean by that is that there's no live offer on a pre-approval, so there's no property that is being evaluated. So a pre-approval technically is just getting you ready and finding out and giving you the advice. But when you go make an offer to purchase, the property has to be valued. So the insurer is probably going to do their own appraisal. Most of the time it's very quick and they can do it without even doing an appraisal. Like, they have enough data on the market to do it. But that's why subject to financing is an important condition in an offer, because really it's that asset has to be valued perfectly, and has to match what you bought it for. And if it doesn't, then you have to even increase your down payment a little bit more, which isn't a really fun transaction if that ever happens. But once you find the home that you want to buy, the property I just said still must be evaluated, so I'm already repeating myself. And we're going to apply the stress test. That's why I said that it's really important to do a pre-approval. There's a lot of calculators on the internet and whatnot, but I just told you about what we do and what we're mandated to do and how we calculate your existing debts that you have with those 3% payments on all your revolving debt, credit cards, and lines of credit. So we have to incorporate your car loan. And then we have to calculate the mortgage payment, the property taxes, and whatnot as well. But what we do as well, and we're mandated, is to do a financial stress test. So we just talked about 4.8% rates and stuff like that for 3 years or 5 years. But when you go to the lender and you go to me, our bank actually has to increase that by 2 additional percent. And we have to get you approved for that, because we want to know, we need to make sure that if interest rates go in the other direction, there is a certain degree that we've already done some calculations that you can afford it if interest rates rise when your mortgage comes up for renewal. Every lender has to do that, whether it's an insured mortgage or conventional mortgage we talked about with 20% or 30% down. It is mandated that we have to make sure that people can afford it in an interest rate climbing environment. So that's why it is a little unique when people say, well, I can easily afford that. But when you add that 2% extra, that's hundreds of dollars more of a mortgage payment than you're actually going to be getting in the end. It's just that buffer and that safety sort of that we make sure that people can afford homes to a certain degree in the future. You have anything to add at all?
We do have
Danica, to that? Oh, you have a question?
Yes, we do have another question here. Do home equity loans make any sense?
Yeah, I mean, they absolutely can. That's a great question. This presentation wasn't really predicated too much towards that product, but that is a very popular product. I actually really, really like that product. But for a first-time home buyer, no, because it's a conventional product. So a lot of first-time home buyers don't have 20%. So even someone who puts down 20% today and buys a home, by meaning it's a conventional product, you have to have like more than 80% equity in the home sort of to do that, right? Because it has to be conventional. So usually it's better down the road for people. So let's say someone buys a home and then 10 years down the road, the house is worth $500,000 and their mortgage is only worth maybe 200 grand. So they have $300,000 of equity. You can't really borrow all of that equity, but we can go up to 80% again on a refinance or an equity takeout. So someone might say, hey, you know what? I want to renovate my home and I want to build a huge addition to it. It's going to cost $125,000. A line of credit could be a great facility to do that, but it's a more complicated solution. A home equity line of credit typically has a higher interest rate if it's kept as a line of credit. So it's a revolving product. A fixed mortgage or a variable mortgage, they're contractual. Like that's your rate, and that's what it was going to be broken down to. The line of credit is just like another line of credit at a little bit better of a reduced rate if you keep it that way. But to complicate things further, why it's more of a sophisticated solution is that when someone uses a line of credit, you don't have to borrow at the line of credit interest rate. You can actually exercise a term option, it's called. So let's say you had a line of credit for $100,000, you borrowed $90,000 of it, and you're like, you know what? I don't want to pay about 7.5% interest on it, because that's essentially what it could be with the home equity line of credit rate. I want to mortgage that. Well, we can just turn it into a mortgage inside the line of credit for that $90,000 and program it to a 3-year mortgage or a 5-year mortgage at 4.7%. But it is quite unique. When clients are doing a conventional purchase, I really like the product. So case in point, I had a client just actually today I met with, they built a brand new home. They need to borrow 80%. It's a conventional mortgage. They're going to come up with 20% on their own. We did a line of credit for 80%. And it's a nice home. It's probably about $400,000, $440,000 line of credit. But what we did is that we gave them the line of credit, and then we programmed the mortgage inside the line of credit for the entire amount. So it's a little complicated, but what my client really likes is that he got a $440,000 line of credit approval for his new home. And there's a mortgage that we termed out inside of it. So he's never borrowing money right now at the line of credit interest rate. I've given it to him on a 3-year rate at 4.84%. And as he pays down that mortgage, he frees up line of credit room for the future. So it is a really cool product, but getting into the market, no first-time home buyers ever get it. I wouldn't recommend it. It's a little more complicated, and they can't even get it because most of the time with 5% down, 10% down, it's not a high ratio product, so it won't work for them. So a little bit of a spiel there. It's a complicated product, but Danica, you have something to say?
Yeah, I was going to say, if you're somebody who owns your own home and now you're looking at leveraging the equity in your property, it can definitely be a good avenue to access. A lot of individuals, if you look at debt ratios, so let's say, for example, they've got a car loan at 6% and then they have a line of credit that's sitting at 13%, and they want to bring those together at a reduced interest rate. A lot of people will opt to leverage the equity in your home in order to pay off at a lower rate because it's a collateral mortgage. Like essentially the line of credit is held collateral against your house. And so the advantage is that compared to non-secured debt, the interest rate is going to be lower. The disadvantage though is that if you sell your home, you have to pay off that line of credit. And so if you're not intending in staying there long term, what can happen is that you go to sell your home anticipating to have a significant equity for the down payment on the next property, but you've actually tied that all up because you've wrapped in a loan, a car loan payment, and a line of credit. And so really understanding what your intention is with the home when you plan on paying off that line of credit, is it going to impact future decisions, are really critical in making sure that that's a right step for you long term.
So most realtors will want evidence that you have been to your mortgage professional lender. So when you go meet with a realtor and they're going to start showing you homes, that's why doing a pre-approval is very important. You will get a certificate that will indicate you've been pre-approved. And it's just great because it allows them to have line of sight of what can you go up to if that's what you're going to do. And then they can start to help make offers on properties with you. So doing a pre-approval is very, very important for that reason. At TD, a pre-approval is good for 120 days. Now, I will add a little bit of an asterisk to it. So, a pre-approvals are good for 120 days, like I just said, but we actually do require to refresh income. I have had clients that I've had pre-approved for a year, and I've resubmitted their pre-approval multiple times because they haven't found the right home. We do need to always verify the income is within a 60-day period. So it's just something that most lenders do because of job change, losing positions. So if you're pre-approved, for 3.5 months ago, there's a good chance a lender will ask you for a new pay stub just to confirm the income's the same and it's from the same source, right? So it's very important to know that. And the added benefit of having your pre-approval ready is you're securing your interest rate. Now, that's a big thing when interest rates are going up because you can actually get locked in at a lower interest rate and we'll still honor that even if rates go up. If rates go down, I always just relower the rate. It gives me line of sight with my clientele so that when I have 20 or 30 mortgages I'm working on, whether they're purchases, new home builds, refinances to do renovations or pay out debt, it's just nice that I can have line of sight and my computer tells me interest rates went down and I need to change each and every mortgage and give you a better rate. So it's kind of a nice phone call to get. Next slide is mortgage prepayments. I briefly touched on that already with one of the slides, I think. But I will say that interest rate's an important aspect, but I do really like to look at the provisions of prepayments so that you can know how much you can actually exercise and pay down your mortgage when your life objectives and circumstances change. You're not always going to make the same amount of money. Especially when you first buy your first home, there's a good chance in 5-10 years your income is going to grow exponentially, maybe through promotions or different jobs or finishing different school. So at TD, you can actually prepay up to 15% of the original loaned amount. So every calendar year, you can do extra payments to your mortgage as principal only payments, and it can't exceed 15% of the original mortgage amount. It's a lot of money. I don't see a lot of clients that really do that. In full, I should say. But as well, on top of that, TD's also got another prepayment privilege. You can do both, is also increasing your regular frequency payment up by an additional 100%. So if your mortgage payment's, $1,000 biweekly, you can make that $2,000 biweekly. So do clients do both of those prepayments? Not that often to the maximum, but it's really good to know they're there. And that's kind of why I tell clients, I don't really worry too much about, going bi-weekly because I heard it pays off my mortgage a bit quicker, but I'm paid semi-monthly. I'd rather go semi-monthly and just make extra payments to the mortgage or set up a savings account and have some extra money going into that. And then every so often go do a lump sum on your mortgage, something like that. Just making sure that it works better on your pay scale or your pay frequency, I would say. That's pretty much it for prepayments. Now your home buying team is probably the next slide, I think, right? Yeah, so as a mobile mortgage specialist, I help my clients from, start to finish. I help clients buying homes, building homes, refinancing homes. The last couple steps, I guess, would be, basically I do everything from start to finish, especially with the way things have changed now. I do a lot of virtual meetings with my customers. With COVID, the whole world changed, just like we're doing today. And we're speaking to a lot of people here and educating on the home buying process. But I deal with clients that way every day. I would say probably 80% of my business is now through video calls or just telephone calls. But then I actually just do the credit application verbally over the phone. We go over details. With first-time buyers, I actually recommend meeting all my first-time home buyers because, again, there's a lot of information. It's nice to have visual aids. Also, with building homes, the options get a little bit more complex because there's different types of builder mortgages and things like that. I like to meet those clients in person as well. But generally, a lot of my business is done through helping my clients with everything to do with real estate, just like a mortgage broker does. And I actually do a lot of e-signs. So in the end, sometimes I can actually help a client without even meeting them in person. We just have a couple conversations. You go buy the house after you're pre-approved. Your realtor sends me all the information. We get you firm approved, and then I just send you the documents to sign, and it goes directly to your lawyer. Quick little synopsis of the whole process. So just trying to rush here a little bit for us. Your realtor, that's a big step after being pre-approved. I work with some really great realtors, so I usually refer my clients to a couple that are really, really great with customer service, and ones that are really good at helping clients buy homes or build homes, with really good with first-time home buyers, and so forth. So skip to the next slide quickly here. Your home inspection, home inspector. So that's something I'll really, really quickly mention because we're over time here. But a lot of people who buy homes, they get home inspections. I don't really deal with that aspect. That's probably more on the realtor side, but a very important thing to do because you're buying pretty much one of the biggest purchases you're ever going to make. So you can actually get a company. There's lots of home inspecting companies. Someone will go down and they'll inspect the home, give you a report, and give you that peace of mind that the house is good. And lawyer. So basically your lawyer will take care of the transaction. So after you're fully approved, I've got you firm approved, your house, you already signed up all the documents for your new mortgage. We then electronically send it to your lawyer of your choice. I also have a couple of recommendations of that for clients too. But the lawyer will then meet with you. You will bring them the down payment. And then they'll get you to sign the legal title work that they secure at Land Titles and put your name on the property. That's how they assist you, and also probably with conditions in the offer, registering the new mortgage, of course, for TD. And that's about it for that one. And closing the deal really quickly, finalizing your mortgage. Sorry, just rushing here a little bit, but you're going with me here. Expect a call from your lawyer to book the appointment in the end after they get all the instructions. So there's a couple of, like, I just gave you the process verbally and I kind of skipped all the steps, but we're trying to get done here at 8 o'clock. And the next slide. So this is kind of important, the help protect your home. There's two different types of insurances people need to consider. That's your home insurance. So you need to get home insurance to protect the home in case there's a fire or damage to your home. And you need to do that through the process. Another cost that you have to budget for as well. But also to protection for yourself and being able to pay the mortgage with health insurance. So all the lenders, you will usually offer life insurance and or critical illness coverage if you want to apply for it. I'm a big advocate for having insurance to protect yourself. So, especially if you have a family and you're buying a home, if something happens to either one of the borrowers, it's really great to have some sort of protection to help pay for the mortgage. Critical illness is a really big one now. I'm seeing more phone calls from clients, unfortunately, as life gets on, get diagnosis of life-threatening diseases, heart attack, stroke, cancer. And in that situation, the bank still pays out the mortgage in full at the time of diagnosis if it's approved. That's a powerful insurance because there's a living benefit to it. A lot of people don't have a lot of critical illness insurance, but there is a cost to it, and your lender can talk to you about it. I could talk to you about it if you're applying for a mortgage, but it is a very important thing to consider when you're buying a home, that you fully protect yourself and your family. Next, I think we're pretty much close to the end here. This one says, now that you're a homeowner, having an emergency fund, we talked about that, having extra cash. Danica already spoke to that a little bit, for a reserve fund and being able to pay for something if something comes up. And added questions, which we probably don't have time for, but and I think that's pretty much about the end.
We have time. Yeah. So, I mean, our schedule is till 8:30, but really leaving the tail end for any questions that people have. And so, if anybody has any questions around the homeowner experience, now's the time to ask. So we've got the chat option and the Q&A option available. And Tyler, you can connect in there and see if anybody's got some questions.
For sure. At the moment, there's no questions, but I will give it a minute or two just for people to get a chance to type some of their questions in there. While we wait, I can throw some questions in here that I had pre-populated. So let me just head over there. I guess the first one is there anything that first-time home buyers should be paying attention to that could have an impact on the resale value that are not typically thought of? So items other than obviously like up-and-coming communities, but maybe some other not so commonly thought of items?
That's a really, really, really good question. I guess dwelling style too could be, something areas of the city when you're looking at buying. Some areas may have a really good like the River Heights area. I always speak to that, and it's got, I don't know what it is, but everyone loves the River Heights area, and homes hold such a good value and appreciate there all the time. There's a lot of great areas in the city, but really that's a question maybe you might want to revisit with the realtor a little bit too. I think I've had people say what the resale benefits or I guess the investment benefits of your first home being a brand new home versus a resale home. Again, I have directed that to, the realtors I work with, because I don't think that's really my purview. Dwelling though, I do see a lot of young people sometimes buying condos, which can work great if that's what you want to do. I used to have a condo myself. I loved it. But you need to make sure you're buying into a good condo. Your realtor should help you with that as well too. But a condo for a young person as a one bedroom, that's where I look at sort of things where I have clients in the past year or two having problems trying to move those condos. Maybe not as many people in the market for a one bedroom condo, right? How does a family buy that property, right? So something to consider. I don't know if that maybe piques the interest a little bit, sort of, or make the spidey senses go a little bit. But I don't know if Danica, you have anything to add to that a little bit.
Yeah, on the condo front, I mean, if you look historically in Manitoba, condos actually depreciated. It's one of the few market areas that depreciated for a period of time. And I think at one point there was a drop of 7%. And so condos can have their challenges in our environment because our city is relatively small. It's easily accessible for standalone homes, so they don't tend to appreciate as much. Neighborhood is really important. So, a good example is I own some rental properties in Point Douglas, and I assure you they are not appreciating. So I can't bank on appreciation of those properties based on the demographic in the area that it's in. So that is really important in considering the location of your home. Other things to think about too is perception. So when you're reselling a home, it is much easier to sell a home that looks refreshed, that looks clean and painted, that has an updated kitchen and bathroom versus something that's a bit outdated. People have a really hard time visualizing. And so a lot of the time, if you have an empty home, it'll sit vacant for a period of time and stay on the market longer because people can't see themselves in it. Whereas when it's staged and it looks a little bit more updated, you can find that you get an abundance of offers. I can reflect on a home where there was significant foundation damage and the home presented very well. It looked very modern. There was probably $75,000 worth of foundation work that needed to be done, but it got ran up by $50,000 on the purchase price because it looked appealing. So curb appeal is really important. But on that side too, being mindful of the age of your home, and foundation is also something that you want to keep in mind. In Manitoba, a lot of our homes are on clay foundations, and so there is a lot of shifting. River Heights is a really good example. St. James is a really good example where you're going to see cracks and movements in your home, and so being really cognizant of that is important, and important on how that's going to impact not only the resale value but also just your overall cost to maintaining it over time. Tyler?
Thank you. So we do have two questions here. One of them has been answered by Chris, but I'm just going to share it as well for everyone. The question was, do we receive a replay of this webinar? So Chris had answered, this is actually going to be on the University of Manitoba website under community and then alumni and then Tuesdays with TD. So thank you, Chris. And then there was another individual who also said, thank you very much for the presentation today.
Yeah, you're welcome. Thanks guys for coming and having us here.
If you guys want, I could throw one more question in here if there's any last questions that are slowly being typed in there. So I guess the other question is, for mortgages that have those 15% annual repayment or prepayment caps, is there any special opportunities or privileges in the event of eligible life situations? So in the event that, for say, a spouse were to pass away and there was a large payout of, for say, life insurance, would it be possible to prepay that mortgage?
If the insurance, I believe, is with TD, like your credit protection that you bought that was added to your overall mortgage payment, there wouldn't be a penalty levied on that. I do believe it was an external payout, and I could probably check into that. Like if you had private insurance of a term, a whole life policy, and then you use that insurance to pay down the mortgage because that was uninsured, I think there would be a penalty by most lenders, I would think. But I could double check on that. So I'll take that as a note, and maybe if we can find out, can we find out who actually had that question? Or
That was just a question that I had pre-prepared while some people were
Oh,
getting
okay.
some messages in.
Yeah, that's a great question, to be honest. I kind of deal mostly with, internal, and I don't even see too often, but a few times in the last couple of years, I had a couple of clients that, had a spouse that passed away or was diagnosed with a life-threatening cancer and still survived for another year or two. And TD did pay out the mortgage in full, and there's no penalty calculation levied for that. But that's all I can speak to right now.
Okay, and we do have one more question here in the Q&A. So the question is, does one have to pay a property transfer fee if one's spouse passes, but the house was only in that name and is getting transferred to the living spouse?
That's a good question. That would probably be something that goes through probate. So if you're living in the house of your partner, I think that was the question, and the mortgage is in their name.
Yes,
I
the way
believe,
the way I'm
that's
reading
more
it
of a
is
legal.
spouse A owns the house and
Yep.
spouse B is also living in it, but spouse A passes away, so it's being transferred to spouse B.
Yeah, that's more of a legal question. I don't have that answer, but yeah, it does have to be transferred. And if it hasn't, I think through, marital law, I'm trying to think of the homestead rights, like that shouldn't be an issue, but there are legal costs to having to have that do that down the road. So I don't know that information. That falls more so under a lawyer, I think. I don't know if Danica, do you know much about that? Have you heard or
Yeah,
know anything about the costs?
I'm pretty sure the answer is no. That if it's a spouse that has passed away when it is being moved over to the other, there's no land transfer tax. But it is something you would want to double check with title's office. However, I'm 95% confident that if a spouse is living in the home and the other spouse is the sole title bearer, when they pass, there is no land transfer tax.
There could be possibly legal costs though, because you have to have a lawyer probably do the registrations, I would think maybe, but that could be.
No, not
No?
necessarily. So in the circumstance, sorry, we'll make sure, Dara, that we're wrapping up here. I just saw the message. But in the situation where the house is in one person's name on their own, it needs to be probated. So the will needs to be probated. So there's a legal cost for the probate of the will. However, somebody can take the death certificate and the will down to land transfers and actually transfer the title into the other spouse's name if they didn't want to have a lawyer do it for them. But a lot will opt to it. And so then you'll have the lawyer fees associated with that. But everybody's situation is different. Other than that, Tyler, is there any other questions? I know Dara wanted to wrap up here.
Yes, there was one last thing from the same person who had put in the previous one, just saying, thanks, in Manitoba, one is allowed to do much yourself. I believe that was more of a comment than a question, though.
Correct. Yeah.
So thank you very much. And I believe that will bring an end to today. And I just wanted to share with everyone, here is Steve's contact information if you wanted to copy that down, but it'll also be included on the University of Manitoba's website.
Awesome. Well, thank you
Wonderful.
guys
Thank
very
you.
much for coming.
Thanks very much, guys.